Please, I'm begging you, don't put too much confidence or faith in your financial advisor. Look, I'm not just bashing the industry. Any financial advisor to steer you in the right direction when it comes to your retirement planning. I'm just telling you, no one cares about your money more than you. So I want to share with you an email I got from a guy who I consider a friend of mine, is one of my Subscribe Star patrons, if you will. And I'm looking for, I don't know where that's at. I got so much stuff in my office here. I can't keep track of all the papers I got when I was wanting to show it to you, but I've shown it to you before. I just can't. It's probably down the basement. All right. So a guy says, on the eve of retirement, people contemplating telling their boss to shove it should do a candid assessment of the market before burning bridges. I haven't done a study, but I'd be willing to bet that in 1999, when a lot of folks hit their retirement number thinking they were ready for retirement, they weren't, and those retirees were screwed come 2000. A lot of would-be retirees probably look at their portfolios every day and think they are all set once they have reached a certain number, without assessing whether we have an overvalued market and that the fair market value of the retirement account is actually worth something less, i.e. not recognizing they're in a frothy market. A simple phone call to their financial advisor or Vanguard could have told them the market was experiencing irrational exuberance and that they should move to the sidelines before telling the boss man to shove it. Having a cash bucket is a wise hedge, but thinking the stock bucket is adequately funded or not overvalued could be a trap for the unwary. All right, so I nothing but the utmost respect for my man here. I could not disagree more with the assessment. So let's go back to what he says. He says a simple phone call to their financial advisor or Vanguard could have told them the market was experiencing irrational exuberance and they should move money to the sidelines before telling the boss man to shove it. That never happens, ever happens. I'm just telling you right now, it'll never happen, ever. And the reason for that, for two reasons, is that these guys get paid on fees. And if you move your money out of the investments that they have put you in, they're going to lose their fees. Unequivocally, they get paid on fees. Now, if you're in a churn and burn kind of portfolio where the guy gets paid commission, it's completely different. The guy says, yeah, I'll pull you out, get paid, and I'll put you back in and get paid again. There's no one ever in the financial advisory industry who's going to sit there and say, you know something, Josh, you're right. The market's, I'm glad you called, Josh. The market's pretty frothy. You should bail out before you tell your boss to shove it. Now, hopefully he says, don't tell your boss to shove it, just because we know there's market chaos every 5 years, every 4.5 years. It's just completely random. It's completely random. No one knew in 2000, at the end of 1999, the market would do what it did. No one did that. Or the irrational exuberance that Greenspan did was in 1995. And just going back to a guy today, I forgot his name, but he posted a great comment on my YouTube channel. Great. He said, buy on the dips. Wait for the dips and buy them. And then his whole point was, well, if you would have waited on the dips to occur, you would have missed that run from the day after Christmas until yesterday. You would have missed that run. And so you're buying. So if it's at 100,000 now, and you're waiting on the dips, and that goes to 120,000, that dips will just say 5%. So now you're down to 115, not even, but just down 115 or something like that, whatever it is. So yes, you can buy on the dip, but you miss that $15,000 a gain. And going back to irrational exuberance, I mean, the Dow at that point is like 4,000 or something like that. It was not. I mean, I don't even think it was that. I don't remember off the top of my head. But the Dow is way down here. So Greenspan says it's irrational exuberant. Boink, boink, boink. And for the next 5 years, you were making, 20% returns year over year over year. So even though the dip happened, it happened well above where you started from in 1995 under irrational exuberance. And on top of that, so are we irrationally exuberant now? I mean, this is what I just did a video on earlier this morning. Is the market frothy? How? I mean, why? Why is the market frothy? Because the only answer is, we have two answers to this. PE ratios are too high. And I explained that. I proved that is not true. Or the PE, heaven forbid, anyone out there, not just this guy, anyone thinks that we're at all-time highs. It's simply not true. It's kind of like you hear something. I don't listen to the radio, but when I used to commute every now and again, interest rates are all-time low. You better lock in your refinance now. Quicken Loans. And you're like, okay. And they weren't at all-time lows. They're not. So PE ratios are not at all-time highs. They're just not. No matter how you look at CAPE, you can look at trailing 12 months, and then never mind if you look at the forward projections, they're not at all-time highs. They're not. Secondly, even if they were, let's take a look at our best friend, our trustee, yield on the 10-year treasury. Where are we? 1.955. We've broken the 2% threshold. I remember last year I did a video in May of 2018. I said 10-year treasuries broke 3%. The era of low interest rates, low mortgage rates are over. And lo and behold, I was 100% wrong. I mean, because who knew? I mean, literally, we have no clue. That's the thing. It doesn't, none of this makes, it's not rational. Keynes, Buffett, Ben Graham, one of these guys says the market can stay irrational longer than you can stay solvent. One of those guys said that. I completely agree more. So, I mean, see, this is the thing. So let's just say we're going to say, I'm telling my boss to stick it up where the sun doesn't shine, because I can't stand that guy. But I'm worried it's a frothy market. Well, I mean, there's always a frothy market. All right, so I mean, it's just it always is. But even here is not frothy when you factor in a 1.99% 10-year treasury. It's just not. Relative to the PEs, which are not at extreme highs, they're not. You can make the case in 2000, the PE ratio is extremely high. Oh, I was at Charles Schwab in 2000. At 2000. Let's see. Did Charles Schwab put out any kind of information, or Vanguard, because I had left Vanguard 6 months previously, did any of them ever put out any guidance that said people who are getting ready to retire should get out of a frothy market? The answer is unequivocally no. No, they didn't. And they shouldn't. That's the issue. We know that Charles Schwab, he says it himself, the guy Charles Schwab. What's going to happen to the markets? They're going to go up or they're going to go down? Exactly. We don't know. So no one said that at Schwab or Vanguard, you should get out of the market. No one said that because frothy what it was, we didn't know. No one knew. And don't forget, you got to factor in September 11th happened. No one could predict that. I mean, so the facts are the market was going on a kind of a normal decline until September 11th happened. All right, but September 11th happened, it changed everything. It had nothing to do with PE ratios at that point because the frothiness of the market had subsided because we were down so much. I mean, don't forget, 2000, the market was down 9%. And going into 2002, the market was down 11%. How much of that was attributed to September 11th? Off the top of my head, I don't remember. But certainly, September 11th, we were down again in 2001 as September 11th. I mean, I was in this. I remember this. I was working in the business. And no one has said you should call the market, tell people to get out who are about to retire. And they never will, because the whole point is you got to stay the course. It's time in the market, not timing of the market. Every single financial advisor worth of salt will say that. And on top of that, every single financial advisor now recognizing they can't beat the market, now they're doing this thing called behavioral guidance. We're going to keep you from making that mistake. And I actually agree to that to some degree. I think it's a little bit arrogant, but still, they're going to say, look, you got to stay in the market. You got to stay in the market because you cannot time it. And I use this all the time. If you miss the top 10 days, just 10 days, going back 20 years, you might have just been in a CD. There's just no other way around that. And people say, but what about the bottom 10? I say, exactly. You missed the bottom 10, you're freaking Warren Buffett next. The issue is no one does that. That's it. No one misses the bottom 10 and is still in there for the top 10. It doesn't work like that, especially with mutual funds, because by the time you execute a mutual fund trade, the market is already closed for the day. So the silliness that we can time the market, if we could, you would not be watching me. I'll tell you that right now. No one can. It's just dumb. So stop with that. So anyway, at the end of the day, no one knew it was a frothy market, relatively speaking. I mean, you could say, yeah, it's pretty highly rated. The PE ratios are highly rated, but Greenspan was saying that in 1995. It was saying that in 1995. Lots of these guys on my bookshelf back there in my basement up my attic say the same thing in 2010, using the CAPE, cyclically adjusted price earnings ratio from Robert Shiller. I mean, that's high in 2010, much, much higher than historical norms. And people say, I remember reading this, just sitting there with my family on vacation, reading possible, let's see here. Hold on just let me see if I can't find this book. I went to Phoenix for a vacation in 2011, I think, and we're sitting by the pool, and I was reading Probable Outcomes by Ed Easterling, and Ed does great work. Tons of stuff in here, and I highlighted like a crazy man, just so much. Just wonderful stuff in here. It's a great book, but his thought process was, again, we are at the market's at a high. He didn't say irrational exuberance because by then people had forgotten about Greenspan saying that in 1995. But his underlying premise was the CAPE, cyclically adjusted PE ratio, the end of the secular bull market is behind us. And that was in 2000. He wrote this in 2000. And let's see. I mean, it's a great book. You should read it. You'll learn a lot. But he was wrong. And we're all wrong. He wrote it in 2010. So in 2010, the cape was high and the market was the end of the secular bear market or bull market was there, and it just was not. Again, just kind of like me saying the end of low mortgage rates are over last year. It's just, I mean, no one knows this. So I do want to share a couple things with you. And I don't have my one from when I used to work at a bank. They had a DLJ, Donald Lufskin Jeanette, and they had this newsletter that my bank, First Citizens Bank, subscribed to, and it said, we expect the S&P 500 to increase as going into 2000. Is at the end of March of 2000. So the NASDAQ was already getting hammered. I can't remember, but I remember at some point that the Dow was already getting hammered. NASDAQ had not. NASDAQ had gone to 5,000. Dow had already got hammered a little bit going to the first quarter of 2000. And they expected a 12,000 Dow by the end of 2000. 12,000. All right, that we know that didn't happen. It didn't come close. So, I mean, that's what I'm saying. So market prognosticators it's literally a crapshoot. In fact, it's a crapshoot with the odds against you because markets go up more than they go to the south. But I'll never forget that. And I kept that newsletter. I got it someplace. I just got a freaking mess of papers here I got to read. I still got to read this one right here by my man Michael Hurd and Suzanne Rodwetter, Economic Preparation for Retirement. This actually, I don't think I cited them in my book, which I probably should have. But these guys talk, it's great. This is from NBER, National Bureau of Economic Research. These guys talk about spending needs and whatnot, and it's just interesting. They're more optimistic take than what some of these other people are. All right, so here's one, why banks beat bonds. And this is, he says, these stocks offer an appealing combination of juicy yields and growth potential, plus they're cheap. And if you notice a date on that is July 24th, 2007. And what happened to bank stocks? They got hammered. All right, so now let's fast forward to Money Magazine. See if you can't see that date line. Let's see there. February 2009. And what did they say? All right, so February 2009. Reduce your exposure to financial stocks. Jeez. So, okay, so they're saying reduce your exposure to financial stocks. In Money Magazine before that, because it's CNN Money, was saying buy financial stocks in 2007 and 2009. They're saying reduce your exposure. Why? The financial stocks took it on its head from 2007 to 2009. So now they're saying get out. You could not have made a worse call than that at all. You could not have at all. And that's, I mean, look, I'm not picking on them. It's fun to pick on Money Magazine because it's so silly, those guys. But at the end of the day, I'm just like, dude, come on. All right, so we know Money Magazine, buy bank stocks in 2007. Don't buy them in 2009, or what do you say? Sell your bank stocks in 2009. By then, you're already down freaking 75%. All right, so let me show you something else. This is not my birthday. This is one day before my birthday. Look at that. 50 cents, Time Magazine, July 6th, 1970. So I was born July 7th, 1970. Fight over the flag, Patriots and put-ons from Time Magazine. Notice that it's only 50 cents is what the cost was of that. All right, what was the market doing on that day? All right, so let's take a gander here. The Dow was down 2% on the day your old buddy Josh was born. You know what it traded at? 675 is what the Dow was. It was down 13.48 points or 1.95% on the day I was born. All right, your old buddy Josh, the Dow was down 1.95%, dropped 13 points. Interesting, huh? Skidding 13.48, the Dow Jones Industrial Average finished at 675 points. It started out with a loss of almost 3 points and then declined almost without interruption. The transportation average fell 1.9 points to 118, closed at its lowest level since 1962. Dow Jones Transportation average, not the Dow Jones Industrial Average, transportation average, fell at its lowest since 1962. So is that a dip? Are you buying on the dips? I don't know. What's the Dow at now? I'll let you be the judge of that, plus you factor in dividends. All right, so now we got, this is another article. Cheaper home. Market slump helps drive down the prices of high-priced homes. Depressed levels of stocks. Dieter, would-be buyers' down payments a barrier. And let me see if I got my little thing here. Use this right here. Look at see my, but use this, you can light, you can take this outside to light to cause a fire because what it does, it pinpoints this. It's called the, I forgot what this is called off the top of my head. I forget everything. I'm an old man. Anyway, but if you go outside, you put some dry leaves on there, you can start your fire by just concentrating the light on a thing. Don't put your hand in there. It'll kill you. All right, so let's see what they say. Don't tell Wayne Mosley that everything is getting more expensive these days. What is the date on this? I can't remember, but I think it's the day I was born. Mr. Mosley, an executive of a maker of modular housing, places 5-bedroom house in suburban Bedford Hills, New York on the market in January at a price that local real estate agents claim was realistic. $54,000. $54,000. I got no clue where Bedford Hills is, New York. He wanted to sell quickly because of a job change, but the house didn't move. So he recently cut his asking price to $51,500, and it still hasn't moved. Everyone is interested, he says, but no one can come up with the cash. He is reluctantly cutting the price again. Mr. Mosley's experience is far from unique. A Wall Street Journal survey of homeowners and real estate brokers showed that price cutting on relatively expensive homes is widespread. All right, so does any of this ring a bell to you? If you bought Mr. Mosley home for $54,500, wherever Bedford Hills is in New York, and you bought the Dow on the date I was born. So let's just say you said, I'm buying Mr. Mosley's home. I'm buying the Dow. This guy, Josh, never heard of him, but I can hear him. He's going on YouTube. I'm going to buy the market. I'm going to buy this house. Where are you later? All right, were we frothy back then? Are we frothy now? It doesn't matter. That's the point. It doesn't matter. Let me just put this up. Can you see me? Oh, look at that. Look at that eyes. Just do it better like this. Does it matter? No, doesn't matter. That's why you need some cash, though, to absorb the cushion, to absorb the fall if it happens. But, man, I just don't fall for this frothiness, because that assumes market timing. And no one in the financial industry is going to do this. They're not going to say you should get out of the market. They're just not. They follow this thing, behavioral guidance, which I agree with, but they also get paid on this stuff to keep you in the market. They don't get paid to put you into cash. And there's no one in financial advisory at one of these big firms that say, yeah, you know something, Josh, you should get out of the market. No one's going to do that, because they have their calls monitored, and their calls are so focused on keeping you in the market. That's it. All right, so lastly, I just want to point out something, too, for the pessimists out there about China. Let's see if I can't find it. This is freaking nuts, man. China, probably not going to be able to find it. China, hold on, let me pause it real quick. Here in China, this is from Business Insider, and I'm not the biggest fan of Business Insider, but I thought this was interesting. A vlogger who fans hailed as a cute goddess accidentally revealed she was much older than people thought after a live stream technical glitch. And they show a picture of her, the cute goddess, I guess, and then who she really is. And what I literally don't care about that. I care about, listen to this, though. This is freaking nuts, man. Hold on just a second. Here we go for the China. Hold on just a second. Okay. The Chinese government, the Communist Party may use this as an example to clamp down on vloggers. The Chinese government, which tightly controls the media and news industry, has been trying to clamp down on live streaming. The Global Times, a state-run tabloid, described the chaotic online celebrity industry as one where no one knows what's really behind the screen, and anything can be transmitted through the internet, including illegal information. But listen to this. Because basically what they're saying is you're telling people who don't know the difference between right or wrong. But this is scary. Hours after a vlogger live streamed herself pouring black ink over a poster of President Xi Jinping in Shanghai last year, authorities deleted her social media account and banished her. Local activists later said police held her into a psychiatric hospital in her home province, more than 500 miles away from Shanghai. All right. So for those who are nervous Nellies about China, they're never going to overtake us. All right, never mind the Paul Samuelsons, the idiocies of this, where their math showing the Soviet Union's on the rampage. They're going to dominate U.S. Communism, lack of freedom can't work. This lady, all she did, she live streamed herself pouring ink on the president, the premier, whatever the hell it is, a freaking communist tyrant. How can you possibly look at that and be negative about America? I mean, look, I get it. The Democrat base are going on. They're talking crazy stuff. And Joe Biden says he's going to throw insurance executives into jail. I mean, these things are nuts. It's not going to happen. I'm still waiting on Trump. Remember all these guys saying Trump was Hitler? I don't see any brown shirts marching through the streets other than Antifa. Now, they are literally the brown shirts marching through the streets. Certainly not Trump supporters. Hell, if you wear a Trump hat, you're going to be beaten up by these people. So the violence in the street isn't by Trump. It's by the communists, the Chinese, throwing this lady in jail for dumping ink on a picture of the president. It's nuts. The only violence in the street here is coming from the left. So the issue is, and these are just tiny, mosquito bites, just because they're not, I mean, how can you not be bullish on this, man? How can you not be bullish when you see our competition is throwing people in jail for throwing ink on a picture of the dude? It's nuts. That's not how freedom works. That's not how competition is created. It's certainly not how ingenuity comes out. If you're a Chinese engineer and you're like, man, I got this great idea for XYZ, you're like, better pass it through the government first? Psh, hell. The government says we're only going to fund stuff that makes us retain power. Anyway, at the end of the day, I'm not saying you got to be bullish on stocks. I don't care. But no one's going to sit there and say the market's frothy or you should get out. Not on my side of the industry, unless they're selling you something, i.e. gold or churn and burn it. For the rest of us, so that's not happening. So just hang in there and be done with it. Recognize if I'm in stocks, I need some amount of cash to weather the storms, and I just need to put the rest in and forget about it. Don't think about it. It does you no good. Stop it. Stop it. Don't pay attention. It's liberating. Like when you get off Facebook, it's liberating. All right, we'll see you next time.